For years, the recipe for winning in the stock market was simple. Buy big tech, ignore the price tag, and watch the AI wave carry you to the moon. But as we head into 2026, the cracks are starting to show. Valuations for growth stocks have hit perfection levels, while high-quality, boring companies are trading at massive discounts. According to a recent interview conducted by themarket.ch with New York Times bestselling author and founder of the Bear Traps Report, Larry McDonald, we are entering a Baton Pass year. Today, we are breaking down why 2026 is set to be the year of value stocks, why the AI hype cycle is hitting a wall of reality, and how you can position your portfolio before the great rotation goes mainstream. Why now? Because the market has become dangerously top-heavy. In late 2025, we saw a market where the entire sectors were priced as if laggards no longer existed. The problem is the fallacy of composition. Investors have assumed that AI earnings can expand infinitely to justify these prices. But here's the reality: AI customers are cyclical. When companies tighten their belts in 2026, those triple-digit PE ratios in tech are going to look very, very heavy. Vanguard's 2026 outlook even warns that if AI expectations aren't met, returns for growth-heavy indices could drop as low as -2%. Meanwhile, value stocks haven't had the AI hype priced in yet, meaning they have a much higher margin of safety. So, what makes 2026 the year for value stocks? 1. Earnings over hype. In 2024 and 2025, stock prices went up because of multiple expansion. Basically, people just decided to pay more for the same dollar of profit. In 2026, the market will demand actual earnings growth. 2. The interest rate floor. Even if the Fed cuts rates, they aren't going back to zero. A higher for longer or even a higher than before environment favors companies with strong cash flow and low debt, the hallmark of value stocks. 3. Creative destruction. We're seeing mean reversion. History shows that when market concentration hits these extremes, the next 5 to 10 years almost always favor the undervalued sectors like healthcare, finance, and consumer staples. You don't want to just buy cheap stocks, you want quality value. Based on the 2026 outlook, keep an eye on these 3 areas. 1. Financials. Bank and insurance companies are finally seeing the benefit of stabilized interest rates. 2. Healthcare. Many major hospital chains and pharmaceutical companies are trading at significant discounts to the broader market despite aging demographics driving demand. 3. Fast-moving consumer goods. As inflation cools in 2026, consumer purchasing power recovers, making these boring stocks highly profitable again. Moving into value isn't about giving up on growth, it's about protecting your gains. The herd is still chasing the 2024 winners, but the smart money is looking at the 2026 survivors. As Sir John Templeton famously said, bull markets are born on pessimism, grow on skepticism, mature on optimism, and die on euphoria. We've had the optimism. Don't be the last one holding the bag when euphoria fades.